Right now, Beyond Meat, trading under the ticker BYND, is sitting at $1.21.05 per share, and it is having a rough morning. The stock is currently down over 5.4%, a drop of about 7 cents from its last close, as the market tries to digest what is left of this company. For many who have watched this stock, the expectation is that it's a coiled spring, a meme stock waiting for a spark, a former high flyer so beaten down that it has to bounce. The online chatter, particularly on forums and X, is filled with talk of a massive short squeeze, pointing to the astronomical cost to borrow the stock as proof that a big move is imminent. But the reality as of this morning is that the stock is plumbing new depths, not because of a mysterious short attack, but because the company's own fundamentals, revealed just 2 days ago, are deteriorating at a terrifying pace. The expectation and the reality surrounding Beyond Meat have never been further apart. The hope you see online is for a technical event, a squeeze that will punish the bears. The reality is that the bears are feasting on a carcass, and the company just confirmed its own struggles. On November 10th, Beyond Meat reported its third quarter 2025 financial results, and it was a catastrophic validation of the short thesis. Let's look past the noise and at the numbers. Net revenues were $70.2 million. While that number technically beat the consensus whisper of about $68.7 million, it represents a staggering 13.3% crash compared to the same period last year. A beat on revenue expectations does not matter when the top line is shrinking by double digits. The company is selling less product, and it is losing more on every sale. The volume of products sold plummeted by 10.3% year over year. This is not a macro headwind. This is a full-scale rejection of the product in the current market. People are simply not buying it. But the revenue drop was not even the most terrifying part of the report. The real story, the one that validated every single short seller's thesis, was buried in the fine print and the delayed SEC filing. The company was forced to record a massive non-cash impairment charge of $77.4 million. An impairment charge of this size is basically the accounting equivalent of a white flag. It is the company admitting that its long-lived assets, the factories and equipment it built during the good times, are not worth what they paid for them. They are admitting that the future cash flows they expect to generate from those assets are so low that they had to write down their value by $77 million. That charge alone is more than the company's entire quarterly revenue. That charge absolutely decimated the bottom line, leading to a net loss of $110.7 million for the quarter. That is a loss of $1.44 per common share. To put that in perspective, the stock is only trading at $1.21. The company lost more per share in a single quarter than the entire share is currently worth. This is the reality that is challenging the squeeze expectation. The company's adjusted earnings per share, the number that analysts watch, was a loss of 47 cents, missing expectations for a 43-cent loss. The adjusted EBITDA was a loss of $21.6 million, also worse than expected. And then the final nail in the coffin. Guidance. For the fourth quarter of 2025, Beyond Meat is forecasting revenues of only $62.5 million. The analyst community, already pessimistic, was hoping for nearly $71 million. This is not a miss, it is a guidance cliff. It signals that the 13.3% sales decline from Q3 is not the bottom, and the company fully expects the situation to get worse heading into the holidays. CEO Ethan Brown, in his statement, tried to frame this disaster as a transformation, focusing on how the company had managed to restructure some of its debt and improve its balance sheet. But a strong balance sheet does not matter if you have no customers. The market saw right through this, and the stock is now collapsing under the weight of these truths. This brings us to the short-selling situation, which is perhaps the most misunderstood aspect of this stock. The retail narrative is that the stock is being held down by manipulation. The reality is that it is one of the most heavily and justifiably shorted stocks on the entire market. Let's look at the data, because this is what investors need to understand. As of the most recent reports, the short interest as a percentage of the free float is sitting at a staggering 36.64%. This means for every 10 shares available to trade, nearly 4 of them are sold short. This is an astronomical number, and it is the primary fuel for the short squeeze narrative. When short interest is this high, it does create a potential for a squeeze, as any good news could force a panic buy. But you have to look at the other two critical metrics, the days to cover and the borrow fee. The days to cover, according to Fintel, is approximately 14.15 days. This metric is calculated by taking the total number of shares sold short and dividing them by the average daily trading volume. A number this high, 14 days, is significant. It means it would take shorts, in theory, over 2 full trading weeks to buy back all their borrowed shares. This is the fuel tank for a potential squeeze. If a sudden catalyst hit, they could not all get out the door at once, which would in turn drive the price higher as they trip over each other to cover. This is what squeeze watchers on Reddit are pointing to, and they are not wrong about the technical setup. It is, by definition, a crowded short. However, the third metric is the most telling. The short borrow rate. This is the interest rate that short sellers must pay to the brokerage firms who are lending them the shares. As of the latest data, the borrow rate for BYND is 26.62%. This is not a typo. Shorts are paying a 26.62% annual interest rate just for the privilege of betting against this stock. This is an incredibly expensive position to hold. Now, here is the key question you have to ask yourself. Why would smart money pay such a prohibitively high fee? The squeeze narrative assumes the shorts are stupid, trapped, and desperate. The reality is often the opposite. They're paying that 26% fee because they are so confident in their thesis. The collapsing sales, the widening losses, the failed guidance, the $27 million impairment charge, that the stock is going to zero or at least significantly lower, and that the 26% fee is just the cost of doing business. They're betting that the fundamental collapse will happen faster than the cost to borrow eats away at their profits. What's your take on this? Is that 37% short interest a sign of a massive squeeze opportunity, or is it smart money correctly identifying a failing business model? For investors looking to navigate this, understanding these signals is crucial. You can find short interest data on platforms like Fintel, S3 Partners, or directly from NASDAQ, though NASDAQ's data is only updated twice a month. A high borrow rate means the demand to short the stock is far outpacing the supply of shares available to lend. When you see this combined with a high days to cover, it's a high-risk, high-stakes situation for both bulls and bears. A coordinated short attack, which some retail investors fear, often involves a research firm publishing a negative report to create panic. But in BYND's case, the shorts don't need a report. The company is doing the work for them, publishing all the negative data anyone would need in its own SEC filings. The most responsible thing an investor can do is to weigh the technical potential of a squeeze against the fundamental reality of the business. Right now, the fundamentals are in an uncontrolled nosedive. Let's briefly touch on what Beyond Meat actually does for those new to the story. This was the company that was supposed to change how we eat. It designs and manufactures plant-based meat alternatives using ingredients like pea protein to simulate the taste and texture of beef, pork, and chicken. At its peak, just after its IPO in 2019, this stock traded at nearly $240 per share. It had partnerships with Starbucks, McDonald's, and Taco Bell. The expectation was that this was the future of food, a sustainable and healthy alternative that would capture a massive share of the multi-trillion-dollar global meat industry. The company was valued at over $14 billion. Today, as of this morning, its market cap is just $87.28 million. That is not a correction, it is an evisceration. The problem, as it turned out, was multifaceted. First, competition flooded the market, from Impossible Foods to store brands at Kroger and private label products elsewhere. Second, the product was, and still is, expensive. When inflation spiked post-pandemic, consumers traded down. They didn't have the luxury to pay a premium for plant-based burgers when they were struggling to afford regular ground beef. The health narrative also took a hit, as consumers realized these products were heavily processed, often with high sodium content. The company's reality became one of shrinking shelf space in U.S. retail, slowing food service sales, and a failed international expansion, which was part of that $77 million write-down. The institutional ownership reflects this chaos. While major passive funds like BlackRock and Vanguard are still the largest holders, as they are in most public companies, their positions are largely a function of index tracking. The value of their holdings has been decimated. Recent 13F filings show a mixed bag of some institutions buying the dip, while many others are selling out of their positions entirely, cutting their losses on a failed growth story. Looking to the future, the outlook is bleak. The expectation for a squeeze remains the only bullish narrative left. The reality is that the company is in survival mode. The CEO's focus on the balance sheet is an admission that the growth story is over, and the news story is about avoiding default on their convertible notes. The risk here is not just that the stock stays low, the risk is delisting. If BYND cannot maintain a stock price above $1 for a consecutive period, it will receive a non-compliance warning from NASDAQ. This often forces a company to perform a reverse split, consolidating shares to artificially boost the price, which is almost universally a sign of a failing company. The upside catalysts are few. A buyout? Perhaps. But who would buy a company with collapsing sales and negative gross margins? A sudden, inexplicable return of consumer demand? Unlikely in this economy.